Welcome back. Now, we'll continue that conversation on financials as COVID cases in India continue to spike higher. Several states have, of course, imposed lockdown-like restrictions, causing quite a hit to industries. Now, to understand the impact specifically on the non-banks, we have Karthik Srinivasan, Group Head, Financial Sector Ratings at ICRA, joining in. Karthik, thank you very much. Hopefully, you, your family and colleagues are all keeping safe. Now, that's exactly our first question, that we know that the big boys are managing this fine and they have exposure to large corporates where business continuity is on. What about the MSME impact? Which are the most vulnerable NBFCs in this environment?
Well, I think largely, instead of getting into names, I would say that, let's take a step back. Last couple of months, we did see an improvement in collection efficiencies. And the second wave of COVID has definitely hit everybody quite hard. While events are still unfolding, we believe that the stress could be higher this year for a simple reason. Unlike the past, wherein a lot of the COVID positive cases were in and around metros and urban, this time the cases are practically all over the country into the hinterland itself. NBFCs generally operate in the tier 2, tier 3 and beyond. So that's something which one is a bit mindful, and one needs to see how things really play out. In terms of large entities are relatively better off for, one, the capital structure is much stronger, and they have been able to mobilize funds from various sources over the last couple of quarters, which has not really been the case for the mid-size and the smaller NBFCs. We did see liquidity profile improving thanks to various regulatory measures and also, tools such as securitizations picked up in Q3 and Q4. With the current situation, we could see some slowdown on those funding avenues as well. To that extent, we see entities which are largely into unsecured, focused entirely towards the self-employed kind of segments to see some kind of stress in case the situation doesn't come back to normal, let's say within a month or so. But from a liquidity point of view, a lot of entities are fairly comfortable for next 3 to 4 months of debt repayment, even at a much lower collection efficiency.
Including MFIs? Including MFIs, is it?
Most of the entities that we cover do seem to have at least 3 months of liquidity on balance sheet. So to that extent, they seem okay. But clearly, NBFC, it's a sentiment-driven kind of a market. The moment you see stress, you could have various kinds of lenders, go a bit slow on lending to other players. So to that extent, it becomes important to ensure that availability of adequate liquidity is there throughout the system and not just only with the banking sector.
Yeah, I remember Rajesh Kumar, again I'm referring to him, the CIBIL CEO did speak about the worry of adverse selection, as he called it. The risk aversion might drive even otherwise liquid entities underground. But Karthik, there are various, in the listed space, there are the truck financiers or the auto financiers, and then there are the generalists who dabble in everything, a bit of MSME lending, a bit of consumer lending, and then there are the housing finance. Which are the categories that you would, how would you put them in terms of pecking order as most safe and least safe?
I think what we've seen in the past sort of holds true today as well, with housing finance relatively on a better footing as compared to other segments. Then you have the secured LAP, it's okay. Then you get on to the unsecured and the MFI largely in that order. CV is somewhere in between, but the thing that needs to be looked out is, unlike last year where you had a nationwide lockdown and the implications were different, this time it is more localized. While I do agree that more and more states are introducing lockdowns, but the extent of the lockdown and the tenor would possibly also be a key driver in differentiating how the credit profile of the underlying NBFCs play out over the next 1 or 2 quarters.
Okay. But have you not put anybody under negative watch as of now?
Not in the last 2 weeks or so. We've already have a negative outlook broadly on the NBFC sector for over a year. We've had quite a number of rating actions, either downgrades or negative outlooks over the last 12 months. And at this point in time, we still seeing how the situation really plays out. As I said, purely from a debt servicing point of view and a near-term liquidity availability to those entities, they seem to be okay. In case things don't improve, then one would probably need to revisit soon.
Karthik, have you sort of collating some projections for the kind of rise in NPAs or maybe the elevation in credit cost for MFIs or NBFCs? Or, I mean, if you had, let's say, an estimate for FY22, are you going to prune it down? Just trying to get some projections here.
From our perspective, we were looking at a broader sectoral NPAs in the vicinity of, about 5.5 to 6% kind of levels for FY22. Let's say a month back, we would have been a bit optimistic and expected the numbers to be at the lower end of the band. But at this point in time, possibly the numbers could be at the higher end of the band. Again, things are evolving at such a rapid pace. It's really difficult to stick your neck out and give a number at the current juncture. But clearly, the developments do suggest that in case things don't improve, we're more likely to see the numbers go at the higher end of the band that we had projected a couple of months back.
This 5 to 6% off how much? What is the numerator? Is it 20 lakh crore? What is the universe you're talking about?
We're talking of NBFCs, so this will be about 20 odd lakh crores, yeah.
Okay.
Or the retail NBFCs. Okay. NBFCs plus MFIs and all put together.
Okay, let me come back to that, the perspective question. On the one hand, you're right that there is no national lockdown and manufacturing is still humming, so that level of activity is continuing. But on the other hand, the negativity this time is 3 times more in terms of numbers of infection, and therefore people are actually sick and are not able to work. That number is higher. There could be bread earners in the family, so retail credit could be impacted because of loss of livelihood or loss of the bread earner. And there is a self-censorship. Even if the lockdown is not imposed, I can tell you from personal experience, so many people just refusing to come out of their homes out of sheer fear. You don't want to end up, sick. So if you looked at this adversity, do you think there is a chance that your 5 to 6% could even break that 6% band?
It could, but again, as I said, the numbers are evolving. It becomes a bit difficult to really stick to a number at this point in time. But I fully agree with you that as compared to last year, the rates are going up, the mortality rates itself are going up. People are not coming to work, so there is production losses. So those issues are definitely there. On top of that, if we are to look at possibly lenders also going a bit risk averse, so in that context, the denominator is probably going to grow at a much slower pace. So optically, from a ratio perspective, the numbers could definitely look higher.
Okay.
The silver lining to an extent could be over the last 12 months, we've seen a lot of banks, NBFCs, MFIs, HFCs significantly increase on their COVID provisioning. So to that extent, there could be a little bit of cushion. But again, it depends on how severe the situation goes over the next couple of months or how sooner does it really come back to normal.
Okay, then leave it at that. Karthik Srinivasan, pleasure speaking with you. Thank you very much for joining us. And in a sense, bridging the twain, there was the set of retailers and restaurateurs who were really on the brink of despair. And then you had the formal sector represented by the stock markets, which is looking through the pandemic. I think Karthik Srinivasan is kind of bridging the two. We'll take a break on that note, and thereafter we're going to come back to the mid-cap